In today's blog post, I'll discuss why tax planning should be boring. Innovative tax strategies can backfire, and policy tweaks often hinder growth and savings. Practical, predictable rules will always beat flashy headlines. Sensible people know that any theory rarely survives contact with messy reality, and nowhere is that more evident than in tax planning. As ministers hunt for revenue without using the word austerity, homeowners, savers, and founders sense the squeeze shifting toward their property and estates. That unease is now very rational. When budgets are tight and political voices are loud, elegant models meet human behavior, and human behavior usually wins. The result is volatility, which is the enemy of investment, hiring, and long-term planning. People hear talk of replacing council tax with a new property levy and imagine their bills trebling in high-value postcodes. They hear of stamp duty morphing into a national sales tax or even applying capital gains tax on a Maine residence, and it chills mobility at the top end of the market. And the markets do not like cliff edges. Neither do families mapping school catchment areas, nor businesses planning for expansion. Every simple change to tax policy invites complex workarounds. And that is why tax advice remains less about loopholes and more about anticipating incentives and protecting cash flow. Politicians forget that predictable rules are the cheapest form of economic stimulus. All of this lands hard on businesses navigating corporation tax, payroll, and financing. Push a broad wealth-style property charge onto paper-rich, cash-light owners, and you freeze transactions. Squeeze inheritance reliefs without precision, and you strangle succession for family farms and small firms while barely denting larger, more sophisticated outfits. The rhetoric from the government says only those with broad shoulders will pay, but the practice frequently falls on the far weaker shoulders of the productive middle, who then shelve hiring, rein back any capital expenditure, and raise prices. That is not ideological, just arithmetic. Investors already saw how tweaks meant to boost receipts can misfire. Capital gains tax rises didn't deliver the haul the Treasury predicted, partly because behavior shifted. Fewer disposals, more holding, more timing games. The same logic applies to property and lifetime gifts. Restricting the 7-year gifting rule or squeezing residence relief clumsily would force families to either delay support for younger generations or resort to opaque structures. Good policy distinguishes between genuine avoidance and legitimate planning within HMRC rules. Bad policy blurs that line and creates resentment without raising much at all. The lesson is to build resilience into your tax affairs. Maintain strong liquidity buffers, as headline reforms often arrive quickly and with minimal transitional relief. Model rates under a range of plausible scenarios, especially those involving revalued properties. Tightened reliefs and longer holding period tests. Above all, keep your records immaculate. In a world where HMRC stretches to police broader bases, the best defense is detailed and accurate documentation that ties decisions to commercial substance. When uncertainty rises, lenders, buyers, auditors, and tax authorities all start asking for the same thing: show me the evidence. The compliance reality for the self-employed is also shifting. Self-employed tax isn't just about deductions. It now intersects with making tax digital timetables, quarterly estimates, and changing thresholds that affect cash timing. Misjudging payment on account and a profitable quarter can feel like a liquidity crunch. Here, precision beats optimism. Align invoicing and cost recognition with tax calendar milestones, and stay wary of how deferred VAT or payroll changes cascade into your tax planning. Small gains in timing often outweigh any proposed relief that might never pass Parliament. What anyone needs from their tax advice is not magic, but method. Map incentives, simulate outcomes, and assume any eye-catching relief can be narrowed or means-tested at a moment's notice. A policy may read well in a think tank paper, Yet on the ground, it can shrink the very base it tries to tax. In practice, those that thrive keep their planning boring. Cash forecasts updated monthly, savings policies that survive a rate shock, and investment criteria that still hold if the exit tax headline number moves against them. Boring wins because it compounds. It is tempting to believe there is a clean trade-off: painless taxes on someone else to fund everything we like. The UK's experience over the past year keeps showing that when a measure looks like an easy win for the Treasury, it often whacks the wrong people at the wrong time and raises far less money than promised. I believe that the most innovative approach to tax planning is to prioritize stability over cleverness, clarity over complexity, and to build a strategy that works even when the next good-in-theory idea arrives on budget day. Boring will always win. The 26th of November 2025 will be an interesting day for all of us, and I, for one, will be watching what the Chancellor announces with great interest. Although I wonder if my head will be in my hands for most of it. If anything I've written in my blog post resonates with you, and you'd like to discover more of my thoughts about Budget 2025 or tax planning for small businesses, then do call me on 01908 774 320 and let's see how I can help you. Don't forget to stay updated with our daily social media posts on Facebook.